Good heavens! Sit down, pay attention, and try. Just try. Not to be completely foolish for the next hour. I don't often take the time to offer such simple advice, but the stupidity I see emanating from the investment world, particularly targeted at those nearing retirement, is truly breathtaking. It's an epidemic of unnecessary complexity wrapped in high fees. If you are 55 or older, you have entered the most precarious phase of your financial life. The rules have fundamentally changed. The goal is no longer achieving maximum velocity. The goal is avoiding the spectacular, crippling crash. Before we even dive into the heavy lifting of intellectual defense, I'll give you the ultimate rule right now, the summation of 8 decades of observing human folly in the market. My number one rule for anyone past the age of 55 is derived directly from the application of the inversion principle. The goal is not to try and get rich quickly. The goal is to avoid ever becoming poor slowly. When we are young, capital preservation is a secondary concern. We have time and future earnings power, which is our greatest asset. A 50% drawdown at age 30 is painful, but recoverable. Time, the relentless engine of compounding, will carry the slack. But for the investor over 55, that equation flips entirely. Time is now a finite resource. A major loss is a permanent impairment of capital, and it becomes catastrophic because the time horizon necessary to recover that capital stretches beyond a reasonable lifespan. The primary economic job of the second half of your life is to avoid permanent impairment of capital. Anything that endangers that prime directive is foolishness masquerading as sophistication. If you find this common sense, and it is common sense, which is tragically uncommon, then you ought to like this video and subscribe to the channel. We are attempting the difficult task of injecting clarity into a subject that is intentionally muddied by people who seek to profit from your confusion. It requires mental rigor, and if you can stick with me, I promise you a framework that will serve you better than any glossy brochure offering 10% guaranteed returns. Now, let's get on with it. That's her. The inversion principle and the catastrophic loss. The first great mental model we must employ is inversion. Warren Buffett and I have used this approach our entire lives. Instead of asking, how do I maximize my retirement returns? We ask the more useful, critical question. What actions are guaranteed to destroy my retirement? For the 55-plus investor, the focus shifts from the accumulation phase, where high beta and aggressive growth were acceptable risks, to the preservation and distribution phase. A young investor is trying to scale Mount Everest. A loss means they slip back down a few hundred feet, but they still have decades to climb back up. The 55-plus investor is already near the summit, tired and running low on oxygen. A slip now means falling into the abyss. The asymmetry of risk is staggering. What constitutes a catastrophic loss in this phase? It's not merely volatility. Volatility, or the temporary fluctuation in price, is something we must endure. A catastrophic loss is a combination of two things: a severe market drawdown and the psychological or chronological necessity of selling into that drawdown. Think about the investor who retired in 2007. They had accumulated a significant nest egg. If they suffered a 40% loss in 2008, 2009, and were forced to sell 4% or 5% annually just to pay for living expenses, they locked in those losses. They were selling shares that were dramatically depressed, guaranteeing that the capital base could never fully recover even when the market bounced back. This is the sequence of returns risk, and it is the single greatest threat to your late-stage financial health. Therefore, our primary rule, avoiding permanent impairment, means structuring the portfolio such that you are never forced to sell essential assets during a panic. How do we do this? We must build a fortress, a financial moat, around the capital we need for the next 10 years. The foolish pursuit of complexity and novelty. The greatest enemy of the older investor is complexity, driven by novelty. When you have a comfortable sum, enough perhaps to live on for the rest of your days, the human mind often finds this stability boring. Boredom, coupled with envy, drives people to take risks they neither understand nor need. The investment industry understands this psychological fragility perfectly. They market complexity. They do not sell simple, low-fee index funds unless they are forced to. They sell structured products, exotic alternatives, private equity for the masses, and the latest iteration of speculative nonsense wrapped in glorious marketing jargon. Why? Because complexity masks the fees, and novelty seduces the brain with the promise of easy, risk-free outperformance. For the 55-plus demographic, your investment philosophy should be rooted in radical simplification. If I cannot explain the investment to a reasonably intelligent, sober 12-year-old, I shouldn't own it. If I need a complicated spreadsheet or a PhD in mathematics to understand how the product generates its return, and critically, how it could implode, then it is a guaranteed avoidance zone. Avoid, specifically, 1. High-fee alternative investments. These often promise low correlation to the stock market, but they usually deliver high fees and low liquidity. Lack of liquidity is the silent killer for older investors. You must be able to access your capital swiftly and cheaply if a true emergency arises, or if a better opportunity presents itself, though the latter is rare. 2. Unnecessary leverage, margin accounts, sophisticated option strategies, or even investing in companies that are themselves dangerously over-leveraged. Debt is a wonderful servant, but a terrible master. And when you are drawing down capital, any amplified loss is fatal. Never use borrowed money to fund consumption or to seek marginal returns in this phase. The potential 1% or 2% boost is not worth the risk of a 25% portfolio implosion. 3. Speculative fads, cryptocurrencies, highly speculative biotech stocks, or any industry that requires massive future speculation about technological disruption to justify current valuation. We have seen these cycles repeat endlessly. People rush in based on enthusiasm, a powerful Lollapalooza effect of greed and social proof, and they lose their shirts. The time for gambling is over. If you must gamble, use 1% of your wealth and consider it entertainment expense. Do not confuse speculation with investment. Chaprana, the tyranny of cognitive biases in later life. My intellectual partner, Warren, and I have spent our lives cataloging the biases that cause investors to self-destruct. For the older investor, certain biases become particularly lethal. A. Availability bias and recency bias. This is the tendency to overweight recent events or information that is easily accessible. If the stock market has returned 15% for the last 5 years, many people in their late 50s start believing that 15% is the normal return. They calculate their retirement based on these elevated expectations. This is catastrophic when reality returns and they encounter a flat market or a sustained downturn. The memory of the 1970s or the early 2000s fades. People forget that stocks can go nowhere for a decade. Our job is to remember the historical truth and plan conservatively. You must anchor your expectations to long-term historical averages, not the last 5 years of euphoria. B. Incentive-caused bias. The broker problem? This is perhaps the biggest single threat facing retirees. If your financial advisor is paid based on the complexity, volume, or turnover of the products they sell you, their incentives are diametrically opposed to your best interest, which is simplicity, low cost, and stability. If an advisor recommends a complex annuity with a 7% upfront commission, they are acting in their own interest, not yours. If they recommend a portfolio of actively managed mutual funds with 1.5% expense ratios, they are ensuring they get paid handsomely while reducing your compounding returns year after year. Understand this deeply. A simple, low-cost, broadly diversified portfolio of index funds, Vanguard or similar, is often the mathematically superior choice for 99% of people, especially those in preservation mode. The simplicity starves the middleman, which is precisely why the middleman tries to sell you something more complicated. Your defense mechanism must be skepticism of anyone who promises something proprietary and wonderful. If it were truly wonderful, they wouldn't need to sell it to you. They'd simply own it themselves. See envy, keeping up with the Joneses. At 55 or 60, many people look at their peers who sold a tech startup early or who happened to be heavily invested in the one stock that went up 100x, and they feel a poisonous pang of inadequacy. This leads to the desperate desire to catch up. Catching up almost always involves taking unnecessary, concentrated risk when you should be decelerating. If you have enough to live comfortably, stop looking over the fence. The greatest achievement in this phase is sufficient capital and peace of mind. Envy is a destructive, corrosive force that has ruined more investment careers and more retirement plans than market crashes themselves. The practical application of preservation, building the defensive moat. Since the rule is avoid permanent impairment, the portfolio must be structured defensively. We must think in terms of liquidity, quality, and low cost. For the investor past 55, I believe the capital structure should be visualized in layers defined by liquidity and expected withdrawal needs. Layer 1, the liquidity buffer, the fortification. You must have enough absolutely safe, highly liquid assets to cover all expenses and planned withdrawals for the next 5 to 10 years. This acts as the insulating layer against the sequence of returns risk I mentioned earlier. This means cash, high-quality short-term treasury bills, or CDs. These assets pay nearly nothing, or perhaps just track inflation, but their job is not to generate returns. Their job is to allow you to not sell stocks when the market is crashing. If the market drops 30%, you draw from your cash layer for 5 years until the equity market recovers. This simple mechanism is the financial equivalent of a nuclear bunker. It is profoundly defensive, boring, and absolutely necessary. Many foolish financial consultants advise keeping only 6 months of cash. That is fine for a young earning professional. It is utterly reckless for a retired person relying solely on their portfolio. 5 to 10 years of buffer means that in a major downturn, you can effectively ignore the stock market volatility entirely. Layer 2, the equity allocation, the quality core. The remaining capital can still be invested for growth, as you may live another 30 years and inflation is a certainty, which eats away at purchasing power. But the character of the equity must change. We are looking for quality, durability, and predictability. This means businesses with deep competitive advantages. The MOAT, we seek companies that possess 1. Pricing power. They can raise prices without losing significant volume. This protects against inflation. 2. low capital intensity. They don't need to reinvest massive amounts of money just to stay in business. 3. History of profitability. Companies that have proven they can survive numerous economic cycles. For the vast majority of people, buying individual stocks to find these gems is a task they are not equipped for. They lack the competitive edge, the circle of competence, that Warren and I possess after decades of rigorous study. Therefore, the simple, elegant solution remains. Low-cost, broadly diversified index funds, such as those tracking the S&P 500 or the total world market. Why index funds? Because they minimize the risk of being specifically wrong. You cannot pick the next Amazon, but you will own a tiny piece of every successful company that emerges. More importantly, you dramatically reduce the drag of management fees, which over 20 years creates a stunning Lollapalooza effect of lost wealth. If you pay 2% in fees versus 0.04% in fees, the difference is astronomical. That money, that 1.96% differential, is money permanently impaired every single year. Layer 3, the inflation hedge, real assets. A portion of the portfolio must recognize that inflation is not going away. Governments facing overwhelming debt obligations have every incentive to inflate the currency. It's the silent tax on saving. We have always preferred owning real businesses over owning paper promises from governments, though we recognize the necessity of the latter for the liquidity buffer. But owning assets that are intrinsically valuable and scarce, or which are necessary for the functioning of civilization, provides a necessary hedge. This includes high-quality real estate, avoiding highly leveraged or speculative real estate, of course, and precious metals, used sparingly and realistically. Gold is useful because it is universally distrusted by every government, yet universally desired by every human when trust in paper money fails. But remember, gold does not compound. It just sits there. Its role is defense, not offense. Understanding the Lollapalooza effect of late-stage failure. Lollapalooza is the term I use for the convergence of multiple psychological and economic factors that combine to produce a powerful, often catastrophic result. In retirement investing, we face a financial Lollapalooza of failure, fueled by 4 simultaneous risks. 1. Longevity risk. We are living longer. If you retire at 60, planning for 25 years, and live to 95, you have a severe problem. You need your capital to last longer than you might originally anticipate. This requires maintaining some exposure to compounding assets, equities, to ensure growth outstrips inflation over 30-plus years. The fear of running out of money is real, but taking extreme risk to avoid it is the path to guarantee the outcome you fear. 2. Sequence of returns risk, the worst start. This is the risk I've emphasized. If your first 5 years of retirement are marked by a major recession, your withdrawal rate locks in permanent damage. This risk is so high that it necessitates the massive liquidity buffer. Layer 1. This is the key strategic decision for the 55-plus investor. 3. Inflation risk, the hidden tax. Even a moderate 3% inflation rate reduces the purchasing power of cash by half in 23 years. You must have assets that grow faster than inflation. This is why a 100% bond portfolio is often foolish for the retiree who might live another 3 decades. You win the capital preservation battle, but lose the purchasing power war. 4. Withdrawal rate risk, the mathematical folly. People often use simple rules of thumb, like the 4% rule, which were derived from historical data that may not hold true in future environments of lower growth or higher volatility. The conservative late-stage investor must be willing to dynamically adjust their spending. If the market is down 20%, you should reduce your withdrawal. A difficult psychological task, but a required piece of the puzzle. If you cannot tolerate the idea of reducing your spending, you must start with a far more conservative withdrawal rate, perhaps 3% or even less. When these four factors converge, living too long, suffering a major crash early, having your fixed income eroded by inflation, and being unwilling or unable to reduce spending, the Lollapalooza effect is financial ruin. The only way to stop it is radical simplification and defense in Layer 1. The wisdom of knowing your limits, the circle of competence. I have often repeated the necessity of knowing the edge of your own competence. This is doubly true in later life, where cognitive speed and learning new complex subjects generally decline. If you have spent your life as an engineer, a doctor, or a teacher, you have developed a deep professional competence, but that competence rarely translates to being an expert stock analyst or market timer. The mistake many aging investors make is the overestimation of their skill relative to the professionals on Wall Street. And I mean the real professionals, not the salespeople. Trying to outsmart the market in your 60s is like trying to learn brain surgery by reading a manual. You're competing against people who do nothing else, possess far greater computing power, and have access to faster information. You will lose. Therefore, the wise decision is often to admit your limitations and default to the simplest, most effective mechanism available, the index fund. This is not defeat. It is strategic wisdom. It is recognizing that the game is rigged against the amateur and refusing to play the game by the professional's rules. Our job in the second half of life is to protect what we have accrued, not to achieve heroic outperformance. Heroics are for the young man with zero capital. Preservation is for the person with accumulated wealth. Avoiding the moral hazards of entrusting capital. A quick word on delegation, which often becomes necessary as we age. When you delegate the management of your capital, you must be excruciatingly vigilant regarding moral hazard. We are talking about the problem of trusting others with your money. My policy has always been to trust no one unless their incentive structure is perfectly aligned with mine. When selecting an advisor, apply the incentive-caused bias model rigorously. 1. Fee structure. Do they charge a flat percentage of assets under management, AUM, or do they charge commissions on trades or products? The AUM model, while expensive, at least aligns their incentive with growing your total portfolio. The commission model incentives them to trade wildly and push high-fee products, often resulting in massive losses for you. Avoid commission-based advice entirely. 2. Fiduciary duty. Do they legally operate as a fiduciary 100% of the time? A fiduciary is legally required to act in your best interest. Many advisors operate under the weaker suitability standard, meaning the product only has to be suitable for you, not necessarily the best or cheapest option. Demand fiduciary status documented in writing. 3. Complexity test. If the advisor proposes strategies that are so complicated you cannot explain them to your spouse, fire them immediately. Complexity is usually a distraction designed to justify high fees and mask incompetence. Your portfolio should be boring. If your advisor is entertaining, you are probably paying too much. Remember, the vast majority of financial advice is simple, cheap, and easily accessible. The vast industry that exists is primarily selling hope, fear, and complexity, because that is where the profit margins reside. The ultimate portfolio prescription for the over 55 investor. I have been asked countless times for a prescriptive allocation. While I dislike one-size-fits-all answers, The philosophy dictates a structural leaning towards safety and quality. If you are 55 to 70 and reasonably healthy, your allocation must respect the fact that capital preservation is paramount, but that you still require growth to combat longevity and inflation risks. 1. The defensive moat: cash, short-term bonds, 30% to 50%. This is your 5 to 10-year spending buffer. Use short-term, high-quality, government-backed fixed income. The interest rate is irrelevant compared to the guarantee of principal return. 2. The quality core: equities, 40% to 60%. This should be diversified. Low-cost index funds are the default. If you insist on individual stocks, they must be the cockroaches, businesses that are so well entrenched they can survive any nuclear winter. Think of businesses like Costco, See's Candies, or well-established utilities and consumer staples that people cannot live without. Businesses that will be here in 20 years and still maintain their dominant position. 3. The real hedge: other assets, 5% to 10%. This small allocation is for real assets that provide diversification against extreme government fiscal and monetary folly. This could be high-quality REITs or a small sliver of physical gold. Notice the emphasis. Safety dictates the majority allocation, ensuring that when the inevitable market panic arrives, and it will arrive, recessions are a permanent feature of capitalism, not a bug. You sleep soundly. Sleeping soundly is vastly underrated. The man who is worried sick about his portfolio is more likely to make desperate, foolish decisions at the worst possible time. Psychological stability, derived from an overly conservative portfolio, is itself a great competitive advantage in the market. We have always emphasized that temperament is more important than intelligence. At this stage of life, temperament means avoiding the panic button, and the only way to avoid the panic button is to build a portfolio that doesn't require aggressive action. The final philosophical check: have we suffered enough? One final thought, derived from our long observation of human behavior: people often take catastrophic risk because they never defined what enough meant. They were always chasing the next percentage point. If you are over 55 and have successfully accumulated capital, you have won the game. You should change your perspective from a competitor to a steward. Your job is now to ensure that the accumulated capital serves its purpose, which is to fund your life without dependency or anxiety. If you find yourself tempted by a sure thing that promises quick doubling of money, use the inversion principle. Assume the result will be a permanent halving of your money. Does that prospect cause you distress? If the answer is yes, then you do not take the risk. If the potential loss is merely painful but not life-altering, you might consider it. But for the older investor, very few risks fall into that category. My ultimate rule remains: focus on avoiding stupidity rather than chasing brilliance. The former is within your control. The latter is mostly luck, often disguised as skill, and profoundly dangerous when you have passed the accumulation phase. For the 55-plus investor, the most valuable asset you own is not the specific stocks in your portfolio, but the secure structure around that portfolio. The massive defensive moat of cash and high-quality debt that guarantees you can withstand the coming storms without compromising your long-term security. That, my friends, is the only true protection for your retirement. Stop complicating things, stop paying high fees, and for heaven's sake, stop gambling.